Welcome to Crypto Capital Trends. Let's talk about FTX. The numbers were staggering. Over $150 billion gone in just 3 days. This was a full-blown meltdown triggered by the shocking collapse of FTX. Investors watched in disbelief as their digital fortunes evaporated. At the center of all this was Sam Bankman-Fried. Sam was the founder of FTX and was now facing accusations of fraud. It was a stark reminder that even in the digital age, the age-old rules of finance still apply. Sam Bankman-Fried, also known as SBF, was an unlikely Wall Street star. Sam was a graduate of MIT. He shunned traditional finance for cryptocurrency. In 2017, at 25, he founded Alameda Research, a major player in the crypto market. In 2019, Sam launched FTX. It was a user-friendly cryptocurrency exchange. FTX offered diverse trading options, catering to both retail and institutional investors. With his tousled hair and casual attire, Sam became the poster child for crypto entrepreneurs. FTX grew rapidly, attracting billions in investments. FTX's meteoric rise was not without its critics. As the company grew, so did concerns of its opaque structure as well as the close ties between FTX and Alameda Research. Rumors circulated of conflicts of interest and a lack of clear separation between the two companies. Some industry observers questioned the sustainability of FTX's rapid growth, noting the company's aggressive marketing tactics and its reliance on leverage, which magnified both profits and losses. There was whispers coming out of a lack of proper risk management. Despite these concerns, FTX continued its upward trajectory. Sam dismissed the criticisms as FUD, fear, uncertainty, and doubt, spread by competitors threatened by FTX's success. Sam maintained that FTX was a well-capitalized and well-managed company, operating with transparency and integrity. However, behind the carefully crafted image of success, cracks were beginning to show. The warnings, once dismissed as mere whispers, were about to become deafening roars. In early November 2022, a bombshell report by CoinDesk sent shockwaves through the crypto community. The report revealed that a significant portion of Alameda Research's assets were held in FTT, FTX's native token. This raised serious concerns about the financial stability of both Alameda and FTX. Binance, a major holder of FTT, announced it would liquidate its entire FTT holdings. This move sent the price of FTT plummeting and set off a chain reaction leading to FTX's demise. Now the Solana connection. The collapse of FTX had a devastating impact on Solana, a faster and cheaper alternative to Ethereum. FTX and Bankman-Fried were major backers, investing heavily in Solana. When FTX collapsed, it took Solana down with it. The price of SOL plummeted, wiping out billions in value. The fall of FTX. The Binance announcement triggered a bank run on FTX. Panicked investors rushed to withdraw their funds, fearing that the exchange was on the verge of collapse. FTX, unable to meet the surge in withdrawals, was forced to halt withdrawals, effectively freezing customer funds. As the crisis deepened, revelations emerged about Alameda Research's misuse of FTX customer funds. According to reports, Alameda had used billions of dollars of FTX customer deposits to cover losses from risky trades, essentially gambling with other people's money. These revelations sent shockwaves through the crypto community and beyond. What was initially perceived as a liquidity crisis quickly morphed into a full-blown scandal involving alleged fraud and misappropriation of funds. Bankman-Fried's carefully constructed image as a crypto wunderkind crumbled, replaced by accusations of negligence and deceit. On November 11, 2022, just days after the initial CoinDesk report, FTX filed for bankruptcy. This marked one of the most stunning collapses in financial history. The company, once valued at $32 billion, was gone, leaving behind a trail of shattered dreams, lost fortunes, and a deeply shaken crypto market. Sam's downfall. The collapse of FTX and the allegations of fraud triggered a wave of investigations and legal proceedings. Regulators around the world launched probes into FTX's operations, seeking to determine the extent of the alleged wrongdoing and hold those responsible accountable. Bankman-Fried, once hailed as a visionary entrepreneur, became the target of intense scrutiny. He faced multiple lawsuits from investors and was called to testify before Congress, where he admitted to making mistakes but denied any wrongdoing. In December 2022, Sam was arrested in the Bahamas, where FTX was headquartered, at the request of U.S. authorities. He was extradited to the U.S., where he faced charges of wire fraud, securities fraud, money laundering, and campaign finance violations. The charges against Sam carried the potential for decades in prison. His trial, set to begin in October 2023, was expected to be one of the most closely watched financial crime cases in recent history. Market and caixation e market and chaos. The collapse of FTX sent shockwaves throughout the cryptocurrency market. It was already reeling from a prolonged bear market. Bitcoin, the world's largest cryptocurrency, plunged to its lowest level in 2 years, while other cryptocurrencies suffered even steeper declines. The impact of FTX's implosion extended far beyond the crypto market. Venture capital firms that had poured billions into FTX and other crypto companies were forced to write down their investments, leading to significant losses. The scandal also tarnished the reputation of the entire cryptocurrency industry, fueling calls for greater regulation and oversight. Lawmakers around the world vowed to crack down on crypto companies, arguing that the FTX debacle highlighted the need for stricter rules to protect investors and prevent fraud. The crypto market, known for its resilience and ability to bounce back from previous downturns, now faced a long and uncertain road to recovery. The collapse of FTX had shaken investor confidence, leaving many wondering if the industry could ever truly shed its reputation for risk and volatility. Picking up the pieces. In the aftermath of FTX's collapse, the cryptocurrency industry began the arduous task of picking up the pieces. Exchanges scrambled to reassure customers about the safety of their funds, emphasizing their commitment to transparency and security. Crypto leaders called out for greater self-regulation. They argued that the industry needed to take proactive steps to restore trust and prevent similar events from happening again. Some proposed the creation of industry-led consortiums to establish best practices and promote ethical conduct. Regulators around the world stepped up their scrutiny of the crypto industry, proposing new rules and guidelines to address the risks exposed by the FTX debacle. The focus was on enhancing investor protection, preventing market manipulation, and combating money laundering. The collapse of FTX served as a wake-up call for the crypto industry, forcing it to confront its shortcomings and address long-standing concerns about transparency, accountability, and the need for robust risk management. Lessons learned. The FTX collapse offered valuable, albeit painful, lessons for the cryptocurrency industry and beyond. It highlighted the importance of strong corporate governance, risk management, and the need for clear separation between related entities. The scandal also underscored the dangers of conflicts of interest, particularly in an industry as nascent and fast-moving as cryptocurrency. The close ties between FTX and Alameda Research, while not uncommon in the crypto world, ultimately proved to be a fatal flaw. Perhaps the most important lesson from the FTX debacle was the need for greater transparency and accountability in the cryptocurrency industry. The lack of regulatory oversight and the opaque nature of many crypto companies created an environment where fraud and misconduct could thrive. The collapse of FTX served as a stark reminder that even in the digital age, basic principles of finance and ethics still apply. Trust, once broken, is difficult to rebuild. The future of crypto. The collapse of FTX cast a long shadow over the future of cryptocurrency. The scandal had undoubtedly tarnished the reputation of the industry, raising doubts about its long-term viability and its potential to revolutionize finance. However, despite the challenges, the underlying technology of blockchain and cryptocurrencies remained sound. The decentralized and transparent nature of blockchain offered solutions to many of the problems that plagued traditional finance, from high transaction fees to lack of access. The FTX debacle, while a major setback, could ultimately prove to be a catalyst for positive change. The increased scrutiny and calls for regulation, while potentially stifling innovation in the short term, could pave the way for a more mature and sustainable crypto industry. The future of cryptocurrency remained uncertain. However, one thing was clear: the industry could not afford to repeat the mistakes of the past. So the collapse of FTX served as a stark reminder that the path to mainstream adoption required not just technological innovation, but also ethical conduct, responsible leadership, and a commitment to building trust with investors and the public alike.